how's it going, guys? Welcome back to the Capital Mindset Show. Today's going to be an update video on a stock we've already covered on the channel. And the reason why we're covering it again is it just dropped, right? By the title of the video, you already know what it is. It's Netflix, okay? So I'll go ahead and shout out the video that was made. And it was made on well, it wasn't made. It was published on the 14th. It was actually made before then. But January 14, 2022, you can go watch that video to kind of see what we said before the information came out. And then this is kind of like an afterthought after the information has come out. What are my thoughts now? Has anything changed? Maybe, maybe not. We'll see. All right, so let's actually begin with the price action. So the Netflix has actually kind of crunched in a little bit because of the overall liquidity crunch we're seeing in the market. Some of these quote unquote speculative assets are kind of coming down. Netflix is not one of those, but it's getting caught in the crossfire with the other high multiple equities, right? And so we'll talk about that when we get to the net income and the PE, okay? So basically, we see this drawdown right here. This massive drawdown is about like 30%, right? So has anything changed in the story of the business? Yes. Okay. So, well, as far as some investors are concerned, right? So some investors are concerned that the growth rate is maturing and Netflix will not be able to grow in the same capacity as it had in the past. Well, there's two ways Netflix grows. It's from users or price increases, right? And they're kind of trying to do both. But the user growth in at least North America and other markets has been starting to slow down a little bit. So they're relying more on price increases. And that's a little bit more risky because if you solely rely on price increases, then you risk losing market share to other competitors such as Disney Plus. We have the Discovery HBO merger coming through soon. We have Viacom CBS with their competitive product at Paramount Plus, and then other little products here and there. Okay. So those are some questions, some concerns that investors might have. And then that's kind of why it's dropped. And again, it was priced for perfection. So when an equity is priced for perfection, the quarter has to be perfect, right? Priced to perfection. So now, again, this video was published on the 14th, 2022. And then subsequently, it actually ended up coming down. So basically, a lot of the opinions expressed in that video were that the company was kind of expensive, right? And then now we're kind of seeing the drawdown. Has it changed, right? Go watch that video if you guys are curious again about what we thought then. So Netflix, if we take a look at, for example, the model right here, ignore this right now because we have to actually have a conversation about the accounting, okay? And that accounting goes to the cash flow statement or the statement of cash flows, right? So their cash flows are basically consistently negative, right? As of more recently. And this is because the company spends a lot of cash in investing into new shows, right? And we discussed that in that last video, right? We said that that was one of my opinions as to why Netflix is a very difficult or more difficult than the average business to kind of analyze, right? And it's similar to the Amazons, right, of the world, where Amazon in the beginning was investing so much into the infrastructure that it was very difficult to actually pinpoint a correct valuation on such a company, right? And this is actually kind of misleading because it assumes that we haven't had ways to analyze such companies before. The answer is it's a little bit more nuanced than that. Maybe for the beginner, it's a little more difficult, but there are strategies and techniques as to how you would evaluate such a business, okay? So for Netflix, like I said in the last video, there is going to be like a range, right? Where you are going to have to rely on your assumptions and analysis to kind of determine what is the average cash flows of this business. Can they grow it at a reasonable rate, right? Will they need to spend so much cash in the future? What level of cash flows will be the default cash flows per se of the business after all the necessary expenses are made to invest into new shows, right? That's a range that you're going to come up with. And everyone can come up with their own, and that requires the skill, right? Or the ability to, and then you can choose to be more conservative, right? But I think in these instances, it is a good place to begin with the net income. I think that that's a good place, like I said in the last video, where the management is utilizing GAAP net income standards, and they're basically telling us the business performance. And that's what GAAP is intended to do. It's designed to do. And oftentimes on this channel, we tend to ignore GAAP or explain GAAP and some of the discrepancies that may occur. You know, if you can check out the Micron, Intel, AMD video where I explain that with the semiconductor businesses. But with this kind of business, you see the script's kind of flipped here. And that has to do with the specific nature of this business. And again, I'm using the word specific because on this channel, I'm trying to explain or say to the world that nuance is very important depending on the business, industry, et cetera, that we're looking at. We have to sometimes change the strategy as to how we're looking at that particular business. Okay, so net income might be a good place to start, right? And we can see here that net income has actually been growing quite nicely. In fact, in 2019 to 2020, it was nearly a double, okay? Will that continue to double? Well, I don't know about that, but it's a good place to start as the actual performance of the underlying business, not necessarily cash flows, because again, the cash flows are negatively affected by cash that's being reinvested back into the business. And again, we have to assume how much of that is vital investment and how much of that is just to grow, okay? Because that's what differentiates that. Money that grows the business or money that is vital to keep the current operations going, maintenance, CapEx, okay? And that's actually not even put under CapEx because it's not really CapEx. It's stuff that's, it's digital assets, okay? So these are the TV shows. So going back to the summary report, let's actually start to talk about this, okay? So they're growing their sales at about 21.1% average per year in the past 5 years, but the net income is growing faster. So we may actually assume a greater growth rate, perhaps, in the net income, right, as they improve efficiencies. And they may actually end up growing faster than we otherwise anticipate, right? So, but we have to kind of gauge the probabilities of all this. And that actually is allowed by the model by creating many different scenarios, right? And so at the moment, right, the analysts say it's a buy, with an average price target of 532.23, implying a 38.5% upside from current prices. Now, what we're asking from the model is, hey, I want 15% required rate of return for the next 10 years compounded, which implies about 304% from here, right? And then we're going to assume some share dilution because they've done so in the past. And sure, let's give it to them. You know, they got to do stock compensation and such. So from there, we're going to assume those. And I want you to ignore the dilution accretion because of what we've discussed in terms of the cash flows. Okay, they're negative for a reason. So it's kind of misleading, that number. And we see that they have a very low estimated WACC and a COCR of 3.71%. So it's very low. So that means, you know, that they're getting capital. They have no problem getting capital. We have an Altman Z-score of about 5.13, which is usually reserved for industrialized companies. However, it can be used for other companies. And again, I've discussed that in previous videos. For those of you not familiar with the Altman Z-score, it's a way of gauging bankruptcy risk within the near term. And there are instances in when it's wrong. One of those instances was AMD, right? AMD, that score, that way of measuring risk was wrong back in AMD, which is again why all these are tools and not something that you should just, you know, rely on 100%. They're tools that help improve your ability to invest, but they do not make you a good investor. Okay. So the other measure of the model is telling me, no, it is not bankrupt within 3 years. Okay. So we're basically insinuating this is a safe business. Okay. As far as bankruptcy goes, let me be very careful how I say that. Okay. So again, here comes back the price to earnings ratio, 33.28, pretty expensive because that's the cash flow basis of which we're going off of. And from there, we're going to then assume some level of growth. And if we can assume 33% or greater, that's where I'm pulling this 33% from. That would imply a PEG ratio of about 1. So the growth is kind of in line with what the price is, okay, or the price multiple. And at that price or at that growth rate, we'd actually be at a buy range, right? And then I think we could even assume 30. And let's see, 29 and 27. Let's see where we can stretch this out. So 28, how about 28? All right, so 28, oh wow, it's exactly there. So at 28% growth rate compounded for the next 10 years, think about what that means, guys. Think about what I'm saying there. Is that possible? Those are things going on, should be going on through your head. 28% compounded growth rate for 10 whole years, then I can expect a 15% rate of return at these prices. If the price comes down further, you know, things get a little more interesting. You can lower those expectations and still maintain that desired rate of return. Okay. So if you wanted, for example, a 20% required rate of return, that's about a 519% return over that time period. And then you can see what you'd have to buy it at given those growth rates. Okay. So again, you could have exuberance in 10 years and the market is paying a crazy multiple, but that's not really evaluating the business on the cash flows. That's evaluating the business on sentiment. So it's very different, right? We don't know what the market's going to be willing to pay for this asset in so years. So then we're just relying on the cash flows, just the cash flows and cash flow projections. And then if the market wants to pay a crazy premium, that's icing on the cake. Okay. So, let's go look at the key ratios and kind of remind ourselves about this business. What do we see? What do we like about it? All right, current and cash ratio, they look terrible, but they're not really that bad. Okay, and that has to do with the ways in which Netflix is actually collecting and expensing its cash, right? There's a lot of cash coming in, and then that's kind of covering all of these expenses. Then they have recurring revenues, right? So it looks worse than what it really is. Okay. And then the long-term debt ratio, it's actually getting better over time, right? They're getting more assets to liabilities. The long-term debt ratio is actually coming down as well. Long-term debt to capital, that's coming down. So things are improving actually on the balance sheet. It's a little bit misleading to look at the liquidity ratios for a business like this. Gross profit margin is rising. This is very good. Okay. What this means, it's the cost of the product. This is the cost of the product. So it takes into account the sales price minus the cost of the product or the sales, right? And then that gives you the gross profit margin, right? So if that's going up, that one means that they're able to, or they're showing us they're able to increase price on their customers and they're getting a higher margin for doing so. This is good. This is scalability. We want to see this. Excellent. Operating margin is going up drastically. This is what I'm talking about with the growth, right? That we're seeing in the net income. The net profit margin, again, margins are coming up nicely. So if this continues in this degree, this business is showing us that it's growing its cash flows at a faster rate than its sales. It's showing us efficiencies that are improving over time. ROA, ROE, excellent. So what I'm trying to say or add actually to that is if Disney and all the other companies are investing heavily into this, right, there's got to be a reason, right? So the reason is that longer term, all these businesses believe that the cash flows, right, after the expenses necessary to grow will be sufficient to make the investment or such an investment worth it, right? So Disney has a library of products, but that doesn't mean that they can't continue to invest into new shows, new movies, et cetera. They have to continue making those same investments. They just have an advantage of a library of products. Well, Netflix is trying to catch up and then the game continues, right? So for those of you who may not know, I'm a big Witcher fan. And so I actually enjoy the Witcher series. I know that might be contested by some, but I enjoy the Witcher series. There's other shows on Netflix that I do enjoy. They just had, for example, Squid Game. And those are all shows that they're going to have to continue to develop. But once they're developed, they're on there forever. So I can always go back and I can rewatch those series that I enjoy, or maybe I don't enjoy some series, you know, but the point is you got tons of options. Okay. Let's take a look at earnings quality. So earnings quality, the way we read this again is actually if it's above 1 in absolute terms. So even when it was negative, it's negative 2.21. We turn that into a positive number and it's above 1, good. So then we see these were iffy times, right? Where the model is telling me, I don't really like the earnings quality too much, but it went right back to 1. So we see kind of like spotty earnings quality, okay, which is quite interesting, but it is what it is. And then we're not going to look at the activity ratios because they don't sell inventory. Okay. So going back to kind of like the bird's eye view of this business, it's an interesting business. I do like Netflix as a company. I'm just not there yet with the price. If I were to say that I'm 100% interested in this business, I would set up a plan. And that plan would consist of, right now, I would be nibbling. Okay. I would just be buying some shares here and there, and then kind of just watching it. And then if it ever were to come down, I would then add more and more and more, right? And I would actually build up the position, right? But at current prices, I'm not comfortable with the projections I have to make in order to justify the investment. But you know what? For me, I think this business has a lot of potential, especially with what they're expanding into gaming and what they can do there. I think there's a future there for them. but I'm kind of I would love to pay a lower price so that I don't have as much risk on the table. And I think it's possible. If things get a little bit more crunchy in terms of liquidity in the markets, we could see some pretty incredible prices. And I'm willing to be patient on that. I'm not willing to rush into something just because I love the business and I use their products, et cetera. I'm willing to be patient, and I'm going to be patient on this investment. So I'm going to nibble, and I'll technically be a shareholder, but I won't really consider it a position. Okay. And then if it just continues to go up from here, cool. I'll just make money on the little shares that I own. But I'm not going to cry about it because there's so many opportunities in the market. All right, guys, on that note, just a little bit of an announcement. Thank you guys so much for your patience on the stock requests, by the way. There are a lot on the list, but I'm doing my best to try to knock those out. And I'm going to try my best to do more than one a day so I can try to keep up. And then in the future, I'm starting to see the growth pains. Eventually, I won't be able to do or accept everyone's requests. I'm going to have to start to be more selective in the criteria, or find a way in which I can accommodate as many people as possible. But yeah, for now, I'm going to continue just to grind through those and then do my best to get those out to you guys. And thank you guys so much for your patience on that. If you guys have any questions about anything I discussed in this video here today, go ahead and leave it down in the comment section below. I'll try to respond within a reasonable time frame. If you guys like content like this, feel free to leave a like button. If you know anyone who's looking into Netflix stock, go ahead and share this video with them. It helps grow the channel, helps me reach out to more people to hopefully provide value and help you guys on your investment journey. All right, guys, on that note, I'll see you guys in the next one. Bye.